Welcome to TradeTheMBI.com. This is John. This report is for the 22nd of September. Well, there's that MBI white and leading, and we always talk about what that does. It's a draw to the 0%. So we were projecting a move that would at least take us to the 4402 and then further to positive extreme, getting further down to the 4317 and potentially even the beginning of the breakout a little bit further. It's just a question of how long that takes to do. Um, I know it seemed like quite a range, but it's when selling starts, that's usually how it takes place. And you can argue what the catalysts for these things are. We can see from the original white MBI spike back over here when we first started with our negative readings at a 50%. If it takes place above the 50%, we usually project that 50% becomes your primary target. When it's below the 50%, the zero becomes the primary target. So in this case, it's just a matter of waiting for that magenta to move underneath the yellow. We had this brief period where potentially bulls could overtake it when it bounced back above. The only difficulty was at that particular stage on our DOC, we had orange caught between cyan and red, which is just continuation. So even though there was a bounce, it was still stuck within that continuation mode because we had no dip below the red line, and we still don't. And then once we saw this significant DOC separation between cyan and green during the plateau, we knew that the next wave of selling was going to take place. And you could see the rollover between the gold, which this was really what was holding things up, where you had just enough support and accumulation of events and the realization of where the Fed was and current economic conditions made it pretty hard to justify wanting to buy more, particularly with the competition you have from treasuries now in yield. The question really only on that one becomes if inflation is ramping up, it's pretty hard to justify uh, treasuries at this particular stage because you expect that rates are either going to remain the same or increase, and your purchasing power would decrease as inflation rises. So um, that spread is a lot better than it used to be when rates were down in the 2% range, but still significantly worse. Now, we knew the NASDAQ had been performing poorer than the S&P, but in this particular case, the NASDAQ didn't fail as hard and only came to the zero, not creating a new one. So um, you can see the differential there where we created the new setup. So that was a big, broader selling overall, and made a significant difference. From a positive extreme standpoint, you can see that we filled back in this level of positive extremes. It does create this whole setup that goes all the way back through here. Um, so quite a bit more of a range for the NASDAQ to be able to fill all of its positive extremes from that standpoint. You can see the rise in treasuries just getting a little extreme right there, but Fed indication, even though they paused, they're not prepared to flip course for the beginning of the year. And the bond market here is kind of suggesting that rates may have to rise additionally. And that would not be a surprise given what we're seeing from oil and how significant that ramp is for inflation coming into the end of the year. And really, that's an interesting one because there's no expectation from what you're seeing from the bond market that there's going to be an abatement in these pressing of prices. Now, the Fed obviously having to slow down, not wanting to create extreme economic hardship. I think they were slow on the curve, and they were too aggressive too quickly, but it's worked out okay so far. They can't continue because to do so would just really um, put such a clamp on things that you would become devastating, and it's not really the goal theoretically. From a euro, this becomes real problematic because now what you can come up with the defense as to why you would want to be in a euro when you can get such a much greater return in dollars. Um, doesn't make any sense. So it's going to be tough for them to hold that line. That's going to require a lot of central bank intervention to keep that from moving back towards parity. From a gold standpoint, it's pretty subdued given what we're seeing. It's very strange because gold really should be on a trajectory back towards its highs. So it's a question of how long that can be held in place. Obviously, when you have a big sell-off day like that, you don't expect a whole lot because you have liquidation issues. But from a Bitcoin standpoint, that um, not doing anything either. So really, there was not a whole lot to be enthused in many quarters from that standpoint. ETH, likewise, we already saw that it was weaker. So you could see that, from that initial MBI spike right there, it was just a matter of waiting for the magenta to dip below. And once it changed colors, we've been in this continuation mode. And it's just been process of working with the AI and that to get that to where we're going to be able to match the paint to those trades and keep that in a continuation mode. And it's been a pretty significant move from that original sell at 44.96 to where we're at, even still within the red, and that shakeout from a 50K standpoint, pretty ugly. From that stage, just improving somewhat. You're in this sort of extreme point where you get a bounce back. We'll get a little red P2 here, which should try to push things back towards the 23%. But you're going to have to get additional improvement from that red DOC back above negative 13.5 for anything to be sustainable. So anything is just literally one of those, it bounces, and that's an opportunity to attack it short again. From a 5-minute chart here looking, you can see that the short started at the pre-market. By the time we got to early open or European session, it was continuing to fade, and then there was just some brief bouts back and forth. But by the time it was all said and done, it was just mostly selling. There just wasn't a whole lot of buys. There were some short covered attempt rallies, but nothing really even to be able to close over the 50% level as it declined. And that's where things stood to the end. And we could see in the post market a little build back up as they try to hunt for any short stops, but how long that will survive, it's still going to be problematic to find people that want to jump in just at this stage. So I would look for a little bit more back and forth. You're going to reach a point where they think they've got too many people push towards the short side, and that will create a great short opportunity bounce. The idea being is that if they can get enough people, it will create a significant enough of a bounce and some momentum to the plus side that you can abate the decline. But the reality is you're still going to have buyers who want to do that. So that really becomes the question mark, and problematic when you have the uncertainty of how quickly the inflation will slow things down. And that's where that oil and understanding where we're at, but that really makes an important difference, and you got to pay attention to it. That's the long and the short of it, though. As always, I'll continue to post updates on the Skype chat. Have a good one.